Hey, welcome back. I came across an interesting fund named GPIX, which is the Goldman Sachs S&P 500 covered call ETF, and that fund has actually outperformed JEPI and XYLD. How did this fund manage to beat the old players, JEPI and XYLD, which are actually the leaders in this category? Let's examine that. That's something interesting, and we would discuss that on in this video, and stay tuned till the end because I'm going to tell you the reasons why GPIX outperformed and also give you a few other funds which have the same capabilities. Let's get started. Before I go ahead, I just wanted to say that this is only a video for knowledge and entertainment purposes. So do your own research and also take professional advice before you make any decisions. Having said that, let's now look at the three players we are discussing. XYLD, JEPI, and GPIX. So XYLD is the Global X S&P 500 covered call ETF, and it was launched back in June 2013. So it almost has a 11 plus years of history or track record. And the second fund is JEPI, which is JP Morgan Equity Premium Income ETF. This was launched in May 2020. So it's almost like close to 4 plus years, and it's pretty popular and pretty well known in the market. And the recent player is the GPIX, which is the Goldman Sachs S&P 500 Core Premium Income ETF, and this is from the Goldman Sachs, and this was launched October 2023. So it basically has 1 year plus history. The interesting thing is GPIX has performed better than the other funds in the last 1 year. So that's just the 1 year performance that we are talking about. So if you take a longer time performance, or if you wait for another few years, things may change. So let's see what are the different areas where we can compare these funds. So when I look at these funds, the in terms of the price return, the XYLD offered about 8.7% returns. Let me show it for you. Yeah, it's the price 1 year ago was 39.57. Today it's $43. And similarly, JEPI, rose from $55.24 to 58.82, and GPIX rose from 44.21 to 50 $50.60. And if you look at the percentage return, um, XYLD made 8.7% and JP made 6.5%, whereas GPIX was the leader, which delivered 14.5% returns. And when you compare that with the S&P, it is about it's delivered 25% close to, and the GPIX is delivering around 14.5%, which is commendable. Of course, the covered call ETFs will underperform, but when you compare that with XYLD and JP, the underperformance is not so much. And of course, GPIX leads the pack with higher return, and JP is the one which is actually the poor one in the pack because they are providing very less returns. And the reason for that is something which we need to examine. Probably that's another separate video on that we can do. And if you look at it, most of the funds are underperforming the index, and that's obviously due to the covered call strategy. And note that this year we had a very good market. You can call it a bull run. So we had a very good higher amount of returns in the index itself. And covered call ETFs are obviously giving you slightly lower returns, but you also have dividends, which is not factored in here. This is only the price returns that we are talking about. And we will see that next. In the next page, we're going to look at the dividend yields. And when I look at the dividend yields, we see something interesting here. Uh, XYLD is providing the highest amount of dividend yield, at 9.2%. So I have calculated all the dividend yields for different funds, and this is at around end of December. Like, so these numbers can change when you are watching the video or when you are looking at these funds. These numbers can always change. So whenever you make any decisions, please do your research. And when I look at JP and GPIX, they are giving slightly lower returns. GPIX is giving 7.8. JP is again lower on the dividend side, 7.2%. So obviously, XYLD is the winner, but it is not fair to say that the other funds are doing bad because their strategy is slightly different. The strategy of JP and GPIX is bit different from the XYLD, which writes the entire portfolio in the form of call options, and they are mostly focused on the income generation part of it. Whereas JEPI and GPIX, they give you the income or the dividends, plus they also give you the capital appreciation. I will explain the strategy at the later part of the video. Stay tuned. And yeah, so that's about it. Like you get more dividends in the XYLD. So someone holding XYLD will enjoy the dividend income, whereas people who look at JP and GPIX are looking for a higher price appreciation. Okay, if you look at the total performance, total returns, this gives you the full overall picture of all the three funds. So you can make a holistic, analysis and see which fund is performing well. And in this case, let's look at XYLD in this table. And you can see the price return is 8.7%, dividend yield is 9.2%. So on the whole, you're making 17.8% on XYLD. And if you look at JEPI, price return 6.5, dividend yield 7.2, total 13.7%. So overall, you're in the lower side. And if you look at GPIX, you're making 14.5%. It's higher in the terms of price returns. And on the dividend yield front, GPIX is somewhat middle of the pack. It's making 7.8, and total returns is about 22%, 22.2% to be precise. And GPIX is the winner overall, and that's why I've highlighted it. And you can also see the S&P delivered about 24.9%. Um, and dividend is 1.3%, so overall 26.2% on the S&P. You cannot see it here, but I can tell you that it's 26.2% for the S&P. So GPIX is almost like closely tracking the S&P's performance. That's a good news here because you're able to almost capture like maximum amount of the performance of the index, and with GPIX you're able to do that. Whereas with XYLD you are able to go up to about 17-18%. With JEPI, actually, you are not able to capture the returns. So that's the drawback of JEPI. GPIX is beating these two old players and significantly, like it's by a bigger margin. Now the question is, what are they doing something different that they are able to beat these two funds? So that's what we will try to uncover next. Uh, so for that, we need to understand a few things. What are the factors that influence the performance? There are various factors. It's difficult to go into everything. I'll just discuss a few of them, probably two or three main factors, and then we'll move into the different funds and see how they are working differently. Okay, first is portfolio coverage. How much of the portfolio is covered by the options? If the entire portfolio is covered by options, it's going to give you low to moderate returns or low to moderate capital appreciation. If the portfolio is not covered by options, on the left side you can see 0 to 30%. Then you are expecting higher capital appreciation. And if your portfolio is like half covered by the options, you get a moderate capital appreciation. On the dividend yield, the more option coverage you have, the more yield. The less option coverage you have, less yield. So that's pretty simple, easy to understand. So to put it in a simple language, higher coverage is used for a pure income oriented fund, and lower coverage is used to capture more upside. So that's what you see in the picture below, 2 points. That's what you need to keep in mind. And you can pick one fund which has income oriented strategy. You can pick one fund which has capital appreciation oriented strategy, or you can pick one of them, or you can combine the two. It's up to you. Like, the way you want to design a portfolio, that's all up to you. I will go to the next factor, which is also important. The next factor would be strike price selection. And this is a little technical. I am not an option trading expert, but from the basis of theory and basis of the concepts that we know about options, and based on my own knowledge about options and my own experience, there are three different types of option strike prices that funds can trade or write on. It could be at the money options, out of the money options, or deep out of the money options. Uh, so basically, at the money means the options are written almost at the level of the current market. For example, if the S&P is at 5,000, you write option at the same level that or close to the same level. It's at the money. If you write options at a higher level, we are talking about call options here. So if the call options are written at a higher level than the market, so basically it's out of money, or if it's too high, it's deeply out of money. So I just put this table to give you a quick um, analysis of that. So in terms of capital appreciation, options which are out of money will give you higher capital appreciation. So if it is at the money, you're not going to get much capital appreciation. So XYLD Global X Fund is not able to give higher amount of capital appreciation. Probably it's low, moderate, somewhere in that range. And they have other ways to maintain their price or NAV. And the JP also probably is not able to go high deep out of the money. There could be various reasons why different funds perform differently, and there's nothing wrong in fund. Actually, you can pick whichever suits your requirement. Like if you're looking for moderate appreciation or if you're looking for higher appreciation, it's up to you. In terms of dividend, it's pretty simple. The funds which write at the money options will give you higher income, and the ones out of money will give you slightly lower income or maybe moderate. So again, summarizing this into simple 2 points, like so at the money options will generate more income, whereas out of the money options will give you lesser income, and capital appreciation is just vice versa. Um, Out of the money will give you more capital appreciation and vice versa. So you don't have to go too technical into it. If you just understand this, then you can choose fund based on your need or your goal. And there are various other factors which are very complex. We are not going too much into this. We'll have a separate video on that, but I will just give you a quick run through on this. So it's the length of options, monthly, weekly, daily, and this can also have an influence. The frequency of options also has an influence on the returns. The higher frequency options, like for example, weekly or daily, can increase your returns because they are able to capture the returns for that period quickly. Like for example, if you look at the weekly options, they're able to do the trading or capturing of the profits or premium every week and pay to you every week, whereas the daily ones will do it on a everyday basis. And this is we are talking about the length of the options, not the dividend payout. That can differ from one fund to the other. Some of them pay monthly, some of them weekly. This is the length of the option contracts that the funds trade. And dividend payout policy, this is specific to certain funds. Uh, for example, the XYLD fund, they retain part of their earnings for reinvestment. So when they do that, what happens is they are able to retain some of the profits or the premiums to maintain the net asset value of the fund so that the fund doesn't have too much of an erosion of net asset value when the dividends are declared. So that is something very positive, and it helps stabilize the long-term performance of the fund and also helps investors to stay in the fund. And people who invest for the medium to long term do not feel that their value of the fund is going down. So it's important for the fund to maintain that value over a period of time so that people don't get worried about the erosion of the value. Like they don't get worried about the value coming down. Instead, they can focus on the long term investment goals and long term prospects. That's about the dividend policy. Next is the OTM calls, out of the money calls. Uh, there are some funds which also, apart from the regular covered call writing, having a index portfolio and writing covered calls. That's the typical formula that most of the funds follow. In addition to that, there are some funds which also buy deep out of money calls. So if the market goes on a rally or a continuous upward movement for several weeks or months, they're able to capture that upside movement and upside returns in terms of the price appreciation. You will find this feature in some funds like SPYI, which is the Neo S&P 500 fund that does covered calls. Plus, they do the extra out of money call selling, call buying. Uh, this is an extra strategy that you can look at. If you look at SPYI, you will understand what I am talking about. And I have also done a video on the SPYI in the past, so you can have a look at it. Uh, there is another factor, that fixed call riding plan versus the dynamic call riding plan. Um, if you look at XYLD, you are familiar with that. They write calls every month, and they write calls on the entire portfolio on a monthly basis, regardless of the market level or uh, and they also write on the entire portfolio every month. Like they don't do like half of the portfolio or small portion of the portfolio, and they don't dynamically change the amount of calls that are written. Whereas GPIX is very dynamic. They can write between 25 to 75% of their portfolio, and which means if the market is very good and their call premiums are very good, they can do more call writing. And when the market is not serving them good amount of premiums, they can reduce the amount of calls written and let the other part of the portfolio appreciate. So when the market is doing really well, but the volatility is too low, premiums are low, then they would reduce the amount of call writing and then let the portfolio appreciate. So that is favorable or good for the investor. So that is something which is enabled GPIX to do well. So that answers one of your questions: why GPIX outperformed XYLD and the other funds. And let's go further and look at the comparison to give you a quick snapshot of all the funds and investment approach. You can look at XYLD. They basically buy the S&P 500 stocks and they write the S&P 500 calls on the entire portfolio. And JEPI is similar, but the only difference is in JEPI they select some stocks in the S&P 500 based on the research and data-driven analysis. So there, what is happening is you are relying on the JP Morgan Asset Management to select certain funds or certain stocks to help you, get the maximum yield or probably capital appreciation. So they select good stocks and also write calls on those stocks which are part of the S&P 500. So it's not an exact index replication strategy uh, like XYLD. So it's a little bit of stock selection and writing calls is similar. We don't know the exact way they write calls, but it should be similar to XYLD, or probably it is similar to other out of the money call writing funds. GPIX, which is from Goldman Sachs, they buy the S&P stocks or replicate the index. Simple strategy. They don't do any stock selection. They buy all the stocks in the S&P as in the index, same composition. And the second part, they sell S&P 500 call options. And now when they sell the options, here they're doing it differently compared to other funds. They would write less or more depending on the market conditions, and it's dynamic, like I explained in the previous slide. So it can be like 25 to 75% of the portfolio are written in the form of call options. And depending on that, your income will can be more or less. So this is more dynamic, unlike XYLD, which is more like a static or a routine, plain vanilla call writing fund. Okay, what is the capital appreciation potential and what is the dividend potential? So when I look at the dividend potential, it's basically moderate in JP and GPIC. So JP and GPICs are more or less same. There is a minor difference in terms of the call writing, but it's more or less the same strategy. And XYLD is more oriented to higher income, higher to moderate income. So that's why dividend potential is slightly more in XYLD. And in terms of capital appreciation, the XYLD is pretty low or probably sometimes moderate depending on the conditions. And JP and GPIX, it could be moderate to high. So for someone looking for growth or appreciation, JP and GPIX are very good options. Uh, if you are someone who is looking not only for the appreciation, but you also want some dividends. If you're a pure growth investor, yeah, you can go for an index ETF like, SPY or IVV. Other options are available. But if you're a growth investor who is also looking for income, or can I say like a hybrid investor who is looking for a mix of growth and mix of income, partly growth, partly income, then JP and GPIX are good options for you. And of course, this is not investment recommendation. These are only a few options which I liked, and some of the funds which are more than 1 year old in terms of track record. Um, and if you look at the JP, like even though there is a high capital appreciation potential, in reality, in 2024, they have given only 6.5% capital appreciation, which is pretty low. So sometimes the strategy will be aimed towards capital appreciation, but in reality, that may or may not happen. So that's why it's important to keep track of funds and their performance. And it's also important to look at other funds or comparables. And it does not mean that you're going to sell this fund and move to something else, but you will keep track of other options to see the performance, and later on in future you can make changes to your portfolio. And with that in mind, I'm going to give you some interesting options. There are some other funds you can consider in the similar space, and these are also funds which can give you returns which are pretty much close to the S&P. Probably these funds are trying to track the S&P much closer. One of them is XYLG, which is the S&P Third Call and Growth ETF. The other one is iSpy, S&P 500 High Income ETF from the ProShares. And if you look at XYLG, they are giving a high amount of price returns, like 17% price return, 4.4 dividend yield, and total returns of 21.5%. So when you compare that with S&P's 26%, it's quite close to S&P. Like you're still underperforming, but you're very close to that, and you're getting 21% return. is it's actually a great performance. Even though the market is very good, but still you're able to capture all these returns in a cover call ETF. That's commendable. And similarly, if you look at iSpy, in this case, what's happening is you are getting a price return of just 12%, whereas you captured 9.7% in terms of dividend yields. And when you add up the two, you're getting 21.8%, almost 22% here for iSpy, which is very close to the S&P. And when you're getting like close to 9-10% dividend yield, and you're getting very good double-digit capital appreciation, that's like a very good sweet spot where you can get a combination of both. That helps you grow your portfolio, grow your wealth. At the same time, you're able to get some income or returns. And that income, if it is significant, you can reinvest and redeploy that income to grow your portfolio, either through more dividends, or you can invest in other funds which can give you growth options. So these are other good options. As we end the video, I would like you to look at these funds also closely. And if something suits you, you can take professional advice and also do your own research and take a call on that. And with that, we are coming to the end of this video. I hope you liked this, and thanks a lot for watching. Please continue to follow the channel and also subscribe if you like what you're watching. Thank you and have a great day.